YouTube, it's Todd Horst here with Tasty Tracker, and today I wanted to go over Iron Condors and why I hate them. And hate's probably a little bit of a strong word. I don't hate them. We'll say I don't use them a lot because I don't think they're practical. So what are we going to cover in this video? We'll do entering and exiting. I'll actually show you how to do it on Tastyworks and in Robinhood, and we'll go over some of the risk and when it makes sense and why I don't like them per se, some recommendations of a real world example and a conclusion. Okay, so getting started, in order to have the primer for understanding a lot of the terminology I'm going to use, you should watch my 16th video. That's Options 101 is the title of that. That will give you a background on calls and puts and selling to open, which is how you open a Iron Condor. And this isn't how most people get started with Iron Condors. Typically you get started with covered stock, a covered call, or maybe buying a call or buying a put, because people tend to think that it's more complicated because there are 4 legs associated with this, and that can be intimidating if you're just starting out. However, when I heard that Iron Condors are a way to make money from the market's indecision, it's sideways action. It'll go up a buck and then it'll go down a buck and then it goes up a buck, and that was driving me nuts when I was trading stocks. So when I heard that Iron Condors were a way to make money off of sideways action of stocks moving nowhere, it immediately was attractive to me. And so that's how I got started in options. My first position was an Iron Condor, which a lot of times brokers won't let you do right off the bat. They want to make sure you're only able to buy calls and buying puts, and so you have to have a higher approval level. I have a video about getting a higher approval level in order to get that to be able to do Iron Condors at first. I just lied about all my experience, which, you know, that's up to you whether you feel comfortable doing that or not, but I felt that I was comfortable enough, and I actually feel that Iron Condors are less risky than flat out buying a call or buying a put. And so from my perspective, I think they have things backwards. I think they're trying to be your friend, the brokers, by only allowing you to do the easier strategies. However, from my perspective, they're more risky and you're more likely to lose your money. So that's sort of the difference there. But anyway, I use Tastyworks, and it really makes it easy to learn the other strategies. So when I first got started, I tried to do options on Robinhood a little bit, and that didn't take me long before I got frustrated with the UI. I think Robinhood is great for buying and selling stocks. It makes a whole lot of sense there because it's free. But when it comes to options, you sort of get what you pay for, and Tastyworks, in my opinion, has a much better platform. That's who I use, and so that's where I'll start showing you. But the really nice thing is they have a strategies button, so you click on that and it will automatically populate the fields. Now, I don't really use that anymore. I just build them all manually, but that's because of the amount of experience I have. But when you're just learning out, to be able to go through each strategy, click a button and see how it creates that strategy for you is great. So I will show you that. If you're interested in them as a broker, I have a link in the description. You don't have to use it if you don't want to. That's fine either way. But I will show how to do it on Robinhood as well, and you'll see how much harder it is to get it done there. Okay, so here is the screen on Tastyworks. I have a whole bunch of red boxes here, so follow along. With this little E indicator, that means that Apple, which is the ticker here, it has earnings coming up, and 22 is the IV percentage. So I guess I'll start off by saying you get this huge screen of information, and it might look overwhelming at first, but it really is nice to see all of these bits of information all at once. Whereas on Robinhood, you kind of have to click around in order to get all the information. And then even then, I don't think they even have IV, but I could be wrong on that because that's not the platform I use. Okay, so generally when IV is high, you get higher premiums. So it's relative to the stock, and it's past, I think this is a year, but the higher IV, the higher premiums are. So at that point, it's best to sell because you're going to receive more credit. When it's lower, like 22 is pretty low, then it may be better to buy, although I'm not a supporter buying. I would still sell it, and I do have several positions on Apple. So here's the strategies button like I was talking about, where you can click that, and I'll do this real time here in a minute, where you can click that and it will pop out and give you all the different strategies. Here's the expiration, and when it can't fit all of it on the screen because of your laptop screen size or whatever, it'll split it up into this. So here is the put side of the Iron Condor, and I'll get into the makeup here, and here's the call side. But right down the center is the strikes, and then you can see that we have it a $5 wide here from 345 to 350, and 407.5 to 412.5. And when you click strategies and do Iron Condor, choose that option. Tastyworks is going to try to put your sold legs here right at around 15% chance in the money. So you'll see both of the sold legs there, and then it does it $5 wide. So you can see the summary here of all of your legs that it took to set it up. So you can see very clearly here the center two strikes are sold. So we have -1 contract here. It's for the August 14th expiration, which is in 15 days. And then on the bottom side is, which it's inverted. So yes, you're seeing the top here, but these numbers are lower. So on the bottom side it's 350, and then 345 is the bought leg, the put. So we bought one put, we sold one put, we sold one call, we bought one call. So the middle two are sold and the outer two are bought. Down in here we have the limit price. Currently, if you leave it unlocked, it will move with the market, and if you leave it locked, that's saying I want to get this amount and I'm not willing to accept anything more or less than that amount. Of course, if they can get you a better deal, they'll still get you a better deal whether you click the lock or not. And it automatically turns this to a credit. When we're opening an Iron Condor, it will be for a credit. And then the time in force GTC is good till canceled. So if you were to hit submit here, it would put this order out there and it would wait to get filled today, tomorrow, the next day, and it would keep waiting until you cancel it, or obviously it passes the expiration date. Okay, so I already covered most of this visually, but we'll talk about this just from the bullet points. So you sell the two inside legs, one call and one put. You buy the two outer legs, one call and one put. Because the ones that are closer to the money are sold, that means they're worth more, and that means the debit for the outer side, the amount of money you pay, is less than what you received on the credit for the inner two, meaning you collect an overall credit for the overall position. So that's one quick way to understand with any strategy whether you should be receiving a credit or paying a debit. What if there's multiple legs involved, whichever ones are closer to at the money. If you're selling those, it'll be for a credit. If you're buying, that'll be for debit. I hope that made sense. If it doesn't, come back to it in a week or two after you do more research, and it'll make more sense then. Okay, so the next bullet point here is to start with, you want to keep your widths the same. So I showed you in the example before, they were $5 wide. So the put side and the call side were both $5 wide. You want to do that to begin with, but as you get more experience, that's not a requirement. You can have one side be as wide as you want and the other one be as narrow as you want, and it really doesn't matter. The only thing that will change is you will potentially receive more credit, but you'll definitely have more collateral required, because the way you figure it out is whichever is wider of the two spreads. So essentially it's a put vertical and a call vertical, right? That's all it is. So if your put vertical is $5 wide and your call vertical is $10 wide, 10 is larger, so that's what it will be based off of how much collateral. So then they take the width, we'll say 10, and say you received $5, so 10 minus 5 is 5, and that means your collateral will be $500. So I have that formula right here, super simple. If you use my website, Tasty Tracker, and you put in the Iron Condor or any of these positions, it will, if it's a risk-defined position, which a covered call and a Iron Condor here, what we're talking about, or a vertical, those are all risk-defined. If it's risk-defined, it will automatically calculate the collateral for you. Okay, so here's an example of when you might want to use this. Say you think Apple's going to stick around 400, and they just announced today the 4-1 split, so it'll be 100 in a couple days or weeks. I'm not sure when that's happening. But say you think it's going to stick around that price range, then you would sell the 15% in the money call and the 15% in the money put. And if you compare that to doing a normal vertical, which I'll have a video on this later, normally I would do verticals 30 to 40%. So you can see doing the Iron Condor is technically less risk because you have a 15% chance that it's going to go through your upside and a 15% chance it's going to go through your downside. So you add those two together to get 30 to make it similar to what a vertical risk would be. If you chose to do 30 on both sides, the odds of it going through one of your sold legs, the price going through one of those strikes is much greater, obviously. So then since you would add those up, that would be 60% chance it's going to break one of those legs. If you want to think of it that way, obviously that math doesn't work quite out because it's still 30% chance, but it's a greater percentage chance because you have both sides of the Iron Condor. Okay, and we already talked about $5 wide on both sides. For simplicity's sake, at first you'll want to do that. Okay, so with closing, you can close just the put side or just the call side. You can close the entire position. You can buy back those center strikes that you sold, and that will remove the risk associated with the position. You'll no longer be able to get assigned shares. So those are all different ways you can close that position. And you can do that at any time. You can close early, the next day after you open up the position, or halfway through until expiration, or just before expiration. Typically with Iron Condors, you're aiming for a 50% of your potential profit. So say you collected $2 to open up your Iron Condor, you would want to buy back for $1. That's just a sort of a standard target. You increase your win rate if you close your positions early. So I'll show you also the POP, the potential for profit, in Tastyworks, which is nice. And you can see what it is just overall, and then what it is if you close at 50%, and it drastically increases it. So if the stock stays in between your sold legs, so here's the put side and here's the call side, and the stock is just staying in your channel like you wanted it to, you can hold the whole way through expiration. I'd still close just before the week up expiration. That's always a good idea with any position. And you can buy back just the sold legs, like I said, for $5 each, and so you're only throwing $10 away. But then you don't ever get into funky situations. You also limit your risk, and so it's almost universally accepted to be proper to close off your positions early. So there are different variations. You can think of an Iron Condor itself as a risk-defined strangle. You can do an iron butterfly, which is just where the sold legs, the call and the put, are at the same strike, and they're around at the money. You want to get it to as close as in the money at the money as you can, or sometimes if you're a little bit bullish, or bearish, you might lean it a strike or two in one direction. But the point is, they're very close to at the money. And a couple of notes on that, but you can think of that, the iron butterfly, as a risk-defined straddle. So the couple notes I have, normally I use the percentage in the money indicator in Tastyworks, but when you're doing an iron butterfly, you'll want to use the mid price as your optional column. And then you're going to choose your legs based on where the cost makes more sense. And I'll show you this because just saying it isn't going to make a whole lot of sense. And when you're doing that, you're going to aim for 25% profit, not 50%. And the reason is because you're strictly playing off of IV and theta, and so every time the stock price moves down, it's going to affect your call and put equally whichever one's negative, the other one will be positive, and vice versa. So so at expiration, you're pinpointing where you think the stock is going to end up. Yeah, let's pause there and I'll go over and show you. Okay, so first of all, we have Tastyworks. Should have signed in before I started this. Okay, so here we have the small account challenge. Currently it's at 3,700. So we'll just go and trade, and AMD was the last stock I was looking at. So first thing I do is make sure I choose the date that I want to, and like always, we're going to aim for 45 days. So the monthly is 50 days. Typically, it's better to do monthlies rather than these weekly expirations. That's what the W stands for. Occasionally, I'll do weeklies if I can't find the strikes that I want. Sometimes they'll have different strikes available, so that might be a reason I go with a weekly. But typically, I'm sticking with the monthlies. Okay, so then the next thing I click on strategies, and then I can click Iron Condor and hit go. Okay, so when I did that, let me change this to percentage in the money. Oh, okay, so this time it put it around 20%, and this one's down at 10%. So let me hit clear. I'm not sure why it would choose this. Maybe it's going off of cost. Yeah, it must be going off of cost. So let's try delta 0.16. All right, maybe it's using delta, which is right around. Those are closest. Sometimes delta is used as an approximate for percentage in the money. But let's go with mid price to 118, 141. No, I think it's going with delta is how it's choosing those strikes. But anyway, we can see that it's a $5 wide, 60, 65, and 105, 100. So in here they have half strikes, and then up here they don't. So that's why there's a gap there, obviously. Okay, and then it's really as simple as that. So say I wanted to make it a little bit wider, you could select the inside legs and click this button to move it in. So this side now is 15 and this side is 10. So if I wanted to rectify that and have them both be 15, then I just deselect that one. And so now they're 15 apart, which means the total position is going to be 15. And since I would receive a credit 5, the collateral is going to be close to 10. And right there you can see 963. Okay. If I want the entire, say I want the deltas to be further, but I want to keep it this 15 wide, I can just have none of them selected and click this way. And there you go. Now we're the whole way down at the 0.02 and 0.07 delta. And it might be skewed, so you might want to play with having the put side closer to the money or the call side closer, depending on if you have a tilt that you want to be more bearish on that position or whether you can collect more premium. Clearly here this would be a terrible trade idea because you're only receiving $100 and you're risking $1,500. So yeah, I don't think so. But anyway, yeah, so I think that's really it here for Tastyworks. Oh, I wanted to show the potential profit. So let me clear this and start with a fresh one. If we go to potential profit, that is 72%. And then if we look at the Pop 50, that's if you close it at 50%, then you have an 80% success rate on this. Obviously, none of that's guaranteed. That's just basically using the deltas to help determine whether what the likelihood of being successful in this trade. But you can see here the call side they're putting at a 10% chance. So this would be a 90% win rate on the call side if you just did that, and this would be an 80%. So together that's adding this together is 30, and so this would overall, if you played this hundreds of times, should play out to be a 70% win rate. Okay, so let's try to do the same thing over on Robinhood. First, when I was doing it on Robinhood, I would always mess this up, and they don't have indicators here for which ones are weekly and which ones are monthly, but you can tell what it is by looking at your calendar. It's always the third Friday. So if I wanted to do August, or let's say I want to do September, that would be the 18th. So I can go down here to September 18th. But yeah, since it's sort of tucked up in here, it looks pretty, but I would always forget to change my expiration. So I like to sell my inside legs first. So yeah, so we'll sell a call, and let's say that's the 85, and then we'll sell a put, and let's say that's the 70, and then you want to buy, and we'll make that $5 wide, and then we'll buy the call, and that's this one, and then you can see right here it will change to Iron Condor, and that's how you know you set it up correctly. But when you do this, notice I didn't get any details on what's what. In order to get that information, you have to click on the actual row, and then it won't have percentage in the money, which is what I prefer to use. Instead, it will have delta. So there you can see this is the 0.27, which is roughly 30% chance in the money. So this is riskier. So even if you're wanting to use Robinhood as your platform of choice, I would still use Tastyworks to set up this trade and determine what strikes I want to use. Then I would come over here and replicate it in Robinhood and fill it here. That's what I would do, and that's what I was doing when I was using Robinhood. Okay. Yeah, so you can use Thinkorswim. It's basically more similar to Tastyworks. You can change this spread from a single to an Iron Condor, but I don't like doing that. What it wants to do here is have different legs that are automatically populated for you, and that's pretty much crazy. I don't know why you would ever do that. So it makes a whole lot more sense to you can do sell an Iron Condor this way, and it will populate your legs for you, and then you can choose the strike down here and customize it that way. So that's what I would recommend if you're using Thinkorswim. One thing I wanted to point out here real quick, because I'll talk about this in a second, is right here under the trade tab, you can see the expected range for earnings is plus or minus $12. So that shows up a couple places in the platform, but it does here on the trade tab. And so that's important. So we'll get into that right now. Okay, so what is the risk? The biggest risk obviously is where the stock will blow through your upside or your downside. And so when you're entering a position, you might want to consider slanting it one way or the other if you have a tilt. Or you might want to consider doing a wider Iron Condor. That's obviously going to reduce your premium, but it is an option. Oh, let me go back here. I wanted to show an Iron Butterfly. So to do that, I'm going to hit clear. I'll hit new Iron Condor. Then I'm going to bring the strikes closer to each other. No, don't want to do that. Okay, so it's 78. I'm going to trade it for the 80s. Oh. And then I clicked the wrong one. Okay, there we go. So then I'm going to do maybe because this is such a high credit, you can determine how wide you want it to be. So let's say we want it to be 20 wide. So that'll put us down to 60. Okay, and we still receive a huge credit. So you're thinking, oh wow, that's awesome. But the difference here is you're going to aim for 25%, whereas an Iron Condor you're going to aim for 50% of when you should take profit. But still, you're receiving a huge credit. And let me see if you can see the payoff here. It should look like a pyramid. Yeah. So because we're receiving such a wide credit, if the stock falls anywhere between these in this green zone, it will be profitable. But it looks like a pyramid here. You can't really see great on this illustration, but it's a pyramid. So you will get the peak if the stock lands at 80 at expiration, and then you will receive less and less and less credit the whole way down here, where this is your break even, and then from there it will continue to slant down. So this is probably not the best view of your risk, but like I was saying, you want to change this to mid, if I can find it. And one way to determine how wide it should be and whether it should be the same on both sides is by looking at the credit received. So right here, this is $30 to go out another 5, and then it's $40 to go out another 5 on this side. So this is actually probably a pretty good place to stop. But if we notice between these two for this strike, so here it's $30, but or $40, I'm sorry. Here it's $40, but then it's $50 between these two. So it's going to decrease the amount of premium you're going to collect with each strike you go out. And here for this, so that's about 70 bucks, right? Between these two, and then to go down another, now we're down to $40. So you can see, yes, you could go out another $5, but you're going to receive less and less and less credit and have more and more collateral. So this is actually probably a good place to stop. You might even want to consider moving this leg up another $5. But yeah, okay. So sorry, that was something I wanted to talk about and I missed. Okay. So the stock can actually land in between your bought and sold leg. Obviously, the wider your put vertical is and the wider your call vertical is, the greater of a chance it is that the stock can land in between there. And that's another reason why you'll want to close the position early. I can say that in all the time I've done it, I haven't had that happen. It obviously can happen and does happen. But if you're managing and closing early for a profit, your chances of that happening are pretty rare, because you still have plenty of time for the stock to move up and down and in your channel. You can get a sign on any of the legs that you sold. That's true for any strategy, and so Tastyworks especially has a video to walk you through that. But basically, you would close the side associated with it. So you would close the put vertical if your put was assigned, or close the call vertical if the call was assigned, or close the whole thing if you need to. I have other videos that I walk through the process of doing that. The last thing here is rolling is a pain in the butt, because you can only do 4 legs at a time. So you're closing the 2 old calls and then opening up 2 new calls, and so that's 4 legs. So you do the call side, roll those out, and then you do the put side separately. So that's just sort of cost of doing business. Of course, you don't have to roll both sides out. I've done it plenty of times, and I have a video called Risky Roll, where you leave on, say, the call side to expire worthless, and since your put side was the challenge side, you roll that out, and then you open up a new call side and collect more premium, but you're only rolling one side of your Iron Condor out. When you do that, though, you need more collateral, so that's why it's risky. But okay, I think I covered everything there. So a lot of people like to do Iron Condors when it's earnings because of the high IV, and then they can make it wide enough that using the expected range here for Apple, it's around $12. So they can make sure that they can go $12 up and $12 down, and that's where they sell their legs, and then they go out another $5 from that, and that's where they buy. And if the predictions are right, then they can capitalize on the decrease in IV, the IV crush on both sides, and it's a bit safer than doing just a put vertical or a call vertical because you're having your legs further out and you're more neutral on the direction. Obviously, Iron Condor is a neutral, which I didn't say that explicitly, but it's a neutral strategy where you don't know or don't care where the stock is going. You just think it's going to stay in between this channel, in between these two prices. The other time it makes sense is after a big move and you're positive the stock is going to stay in a specific range. So why do I hate them or rarely ever use them? I love the idea of using time, which is theta, and vega on my side, and just receiving money every single day that the stock doesn't go anywhere. But the reality is that theta does not play as big of a role as price action does. So I've switched my practice from doing a lot of Iron Condors to doing a lot of put or call verticals, mostly put because I like to play stocks that are going up. But when a stock moves my direction, then I'm benefiting from that as well as time, the passage of time. If you're doing an Iron Condor and the stock moves up and it starts to press on your call side, then the put side is going to increase in value, but the call side is going to decrease in value. And so those basically offset. And so you'll end up completely not benefiting from the movement of the stock. So my personal preference is I would rather choose stocks that I think are going to go up and then put on a put vertical, credit put vertical. Okay, so I liked theta and vega. I liked that you could choose legs that were further out, which in theory then would be safer, and they're at 15% in the money as opposed to being 30% in the money or 40% in the money. So in your head you're thinking, okay, well, I'm going to get pressure against those sides less than if I had a put vertical or a call vertical. But in practice, one side always gets touched. It's inevitable, and it's quite frustrating to know that if you would have only done one side, if you didn't sit on the fence, if you picked a position, a stance on that stock, that you would be making money, and now you're potentially losing money or certainly not making any money, just sort of trading sideways because you didn't put your foot, draw a line in the sand, put your foot down. A lot of times it does come back in the channel. It's just a question of when. Many times, as luck would have it, it's going to be after your expiration. So you deal with that kind of crap where it's not moving where you need it to be when you need it to do it. And because I already talked about it, when you're playing both sides, as one decreases, the other one increases, and they cancel out. So I already talked about that a bit. Okay, so if you're going to put on an Iron Condor, what you need to do is obviously choose a stock you like. Preferably it's very flat, or it's had a big move, and so you intend and expect that it's going to go flat for the next month or two, next 45 days, like we said. And that's very, very common. If you see a big jump in a stock, it legs up to the next level, it's going to consolidate there for a bit before people are willing to have it go any higher. So you'll see it spike up and then it will sort of trail off and go down just a little bit, and that's a good time to have an Iron Condor around it. Obviously, the options need to be liquid. So just because you see a big move or you like a stock doesn't mean it's going to be good. A lot of times these flat stocks are terrible with option liquidity because nobody's interested in them because they're not moving anywhere. Or maybe they do have options and you can get in and they're liquid enough, but there's no premium there to make any money off of that way as well. So that's another reason why I don't use these as much. But as always, we would recommend the 50, 45-day around that time expirations. And here's an example, which I sort of went over when I pulled up the broker. AMD is currently trading around 76. So you could do the 55.60 on the call side, which means you sell the 60. And you do the 95-100, which means you sold the 95, you bought the 100, and those are both around 12 to 15% in the money, and you receive an 82 credit. But because it's $5 wide on both sides, that means you're going to pay $420 in collateral. They're going to hold $420, and you'll only get 82 credit. So I guess one nice thing is if you were to just do one side, and you had a 15%, you're going to receive basically no credit, half of that, $40, for a $5 wide spread. And so you're risking $460 to make $40, and that really, really doesn't make sense. So the one saving grace is that you're collecting premium on both sides. And that's why when we're doing just a put vertical or a call vertical, we have to choose a greater in the money, percentage in the money. Otherwise, the premium is not worth it. Okay, so it still makes sense occasionally. I do it a lot on Chipotle for some reason. I've just always done Iron Condors on Chipotle, and if it's worked out, so I continue to do it. I do sort of feel like every stock sort of has its thing that you can do, or at least that you can make work with that stock. And so for some reason, whatever it is, I tend to be good at Iron Condors on Chipotle. So I keep doing it. I'm not fighting it because it's working. So that's a position you'll see me do frequently. And I don't hate them enough to not do them. It's just not my preferred tool, the preferred setup that I like. In my opinion, it's way better to get started with options doing an Iron Condor as opposed to covered calls or buying calls and buying puts. It makes a whole lot more sense. The risk profile is there. You can make more money. You're benefiting from theta and vega, so you're learning some of the Greeks. And yeah, I think it just makes a whole lot more sense to get into the weeds with options than doing some of these. And the cover call and the buying calls and puts are lower success rate. So those are 50% success rate or less. And I mean, technically speaking, cover calls are more because you have the stock, which is 50, and then the cover call increases it. But that's besides the point. The point is you're going to lose out if you're buying calls and you're buying puts. That's why anybody you follow that's doing that, their account goes all over the place and it's not predictable. Iron Condors, you can have predictable income from maintaining a position. They're really good with ETFs. So ETFs don't move as much as a single stock. So although I mentioned CMG, I've done a lot of iron butterflies and iron condors on XBI and Russia, Mexico, a bunch of those ETFs, the gold, TLT, bunch of those ETFs are really, really good because they don't move as much as a regular stock. So as long as it's a highly traded ETF, that's a good route. So ultimately, I personally feel that I'm better at choosing a side, and so that's why I do put verticals and call verticals. And I like benefiting from the stock movement as well as theta and vega. So there's sort of three factors there working on my side, if I'm right. Doing Iron Condors, you really only get two of those benefits. So anyway, I hope you liked that video. Definitely ask questions in the comments if you have anything that you want further explained. I can always remake this video and add in any details that you want. So check back, weekly. I've got lots of videos. Tasty Tracker is my site. It's for tracking your options and stocks, and I'm basically adding new features there every week. And it's free to create an account, so there's no reason to not do it. There's no credit card or anything like that. And then also, if you're interested, you can use my Robinhood and Tastyworks sign up in the description below. I'm undecided yet. I'll be doing the next small account challenge either in Robinhood or Webull, so let me know what you would prefer in the comments below if you have a preference. And as always, these are just my opinions, but yeah, thanks everyone, and I'll talk to you next time.